Welcome to Investor's Guide. You're watching ET Now. Thank you so much for joining us. This is the show that helps you find the perfect investment products in the market by looking at what suits your needs best. Remember, this is our special episode for our retired viewers. Right through the show, we're going to be answering your questions and we're going to help you plan out a financial plan that will allow you to beat inflation and make your money grow. You can write to us at the email ID that's flashing at the bottom of your screen right now. Over the next half hour, we'll first put together an entire financial plan for those of you who are retired. In our product review this week, we look at the HDFC Prudence Fund and we'll tell you everything you need to know about the Rajiv Gandhi Equity Savings Scheme that was launched this week. Well, you've probably spent your entire working life saving up for your retirement, and now it's time for that money to start working for you. Now, you'll only be able to enjoy your retirement if your money grows during your golden years. So we've put together this investment option list that can make the most of your retired life.
Retirement should ideally be the start of a relaxed and comfortable life, like taking long walks in the park and finally getting to know your friendly neighbor. But the rising cost of living is making it difficult to sustain this carefree life over a long period of time. So you need to keep investing well into your retired life. Of course, your investment plan post-retirement will be significantly different from when you were working. In fact, it is now the job of your investments to provide you with a monthly income for the rest of your retired life. First things first, invest in a senior citizen savings scheme which will give you returns of about 8 to 9%. If the returns from the senior citizen savings scheme are falling short for your monthly expenses, you need to invest in a few additional fixed income instruments. These are conservative investment products that generate a monthly income without exposing you to the volatility of the stock markets.
Post office monthly income scheme, again you get a regular income coming out of that. That's about 8.5%. Then we have fixed deposits which offer different kind of rates. We have bonds. So bonds issues keep coming, and depending on the market circumstances, interest rates go up and down. But right now, for example, we have tax-free bonds in the range of 7 to 8%. Then we also have an option of putting money into debt-based mutual funds.
Your third option is to put your money into an immediate annuity plan offered by insurance companies. These plans don't have a limit on how much you can invest, and they allow you to choose how regularly you want to pay out.
Typically, the life annuity with return of premium, which basically means that if you put 100 rupees, you would get something on a monthly basis, and on your unfortunate demise, your nominee would get the 100 rupees back. So, I mean, somebody could just live from, let's say, 58 to 100. So you get 30 or 42 years cover straight away. And this 100 rupees is still intact. That goes to the nominee. A product like this would broadly give in the range of about 7.25, depending upon your age.
Currently, the immediate annuity plans that are available to you are the ICICI Prudential Life Insurance Immediate Annuity, HDFC Immediate Annuity Plan, Reliance Immediate Annuity Plan, SBI Life Immediate Annuity, ING Immediate Annuity, and LIC's Jeevan Akshay 6 Immediate Annuity Plan. Now that your regular income is taken care of, it's now time to battle inflation. Even at a moderate 5% rate of inflation every year, your monthly expenses of 20,000 rupees today will compound to over 53,000 rupees in 20 years. While fixed income investments can be relied upon for a steady flow of income, they are not designed to keep pace with your increasing expenses. To avoid this depletion in the value of your capital, you need to invest in equity.
Generally, an equity mutual fund is a good way to start, because you're not getting the full complicated exposure to a single script, and you're getting the benefit of a fund manager and all the other reasons that you choose a mutual fund over direct securities.
Since we're talking about senior citizens, what they want is large cap companies which are less volatile. I would like to recommend them to start with an index fund. An index fund is one which replicates the index and which predominantly has large cap companies.
After retirement, your ideal allocation to equity should be about 25 to 30%. However, keep in mind, as you grow older, you should rebalance your portfolio to bring down your equity allocation and thus minimize your exposure to the stock markets. And finally, Make sure to set aside a contingency fund of 6 months' expenses and buy adequate health insurance before you chalk out your investment plan.
We hope that helps. Now, after you retire, of course, your biggest expense is healthcare. And as you grow older, these minor aches and pains add up to quite a hefty medical bill. So it's mandatory that you buy enough health insurance to make sure your savings are not eaten away at because of those medical needs. Take a look at the health insurance policies in the market that cater specifically to retired customers.
No matter how old you are, your financial plans should always begin with health insurance. And this is doubly important for senior citizens. You should ideally buy as much as health cover as you can afford. But make sure your cover isn't going to run out when you need it the most.
Rule of thumb we generally use is that at least 5 lakhs today per person is good to have. So if you have health insurance of less than 5 lakhs, then you may want to look at a top up on that amount.
Now ideally, you should have bought a health cover about 5 to 10 years before you retired. This would have brought down your premiums significantly. But if you didn't buy one, the good news is that insurers have now designed health insurance products specifically targeting senior citizens. The plans that you can choose from are the Senior Citizen Red Carpet from Star Health, Optima Senior Plan from Apollo Munich, Varishta from the New India Insurance, Silver Health from Bajaj Allianz, and Varishta Bima from National Insurance. Keep in mind, these policies are only available to those of you who are above the age of 60. And you will need to undergo an extensive medical test before you get a policy. There are also a set of policies that are open to all age groups, including senior citizens. These are Heartbeat from Max Bupa, MediSure Classic from L&T Insurance, MediClassic from Star Health, and MediClaim from New India Assurance. But before buying one, keep in mind the waiting period in these policies could be anywhere between 2 to 4 years. While you have plenty of options to choose from, make sure you check in a few basic aspects before making your purchase. First up, find out the waiting period on the policy. The waiting period refers to a number of years you have to wait till the new insurer will start covering a pre-existing illness. Most senior citizen plans have a waiting period of 1 year. If you need a medical care for that illness for the first year, it will have to come out from your own pocket. Second, go through the fine print of your insurer's claim ratio. No policy will cover the entire medical bill. You will have to shell out a portion of the expenses while the insurer makes up for the rest. Third, calculate your annual premium and compare it with the premium on other policies.
Premiums vary based on what all cover are they giving, what are inclusions, what are exclusions, is it only for hospitalization, is it for some kind of treatment at home.
For a cover of 5 lakh rupees, your premium could vary from as little as 22,000 rupees to a whooping 96,000 rupees depending on how old you are. Now a lot of you may be covered in a family floater plan. These plans cover the entire family, but the premium is decided by the age of the older member. This isn't the ideal cover for senior citizens. But if you already hold this policy, don't be in a hurry to get out of it.
So if you have a plan, continue with it. Now in case you are falling short and you want to look at additional cover, then instead of buying a fresh individual plan, I would suggest look at a top-up cover.
And finally, make sure you are carrying your policy ID or the policy number with you at all times. Also, making note of the 24-hour helpline is a good way to ensure you get the best medical care when you need it the most.
We hope that helps. It's time for me to introduce Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week on this show. Dhirendra, thank you so much for joining us on Investor's Guide. This is our special episode for retired people and for senior citizens, which is why I'd like to talk about the portfolio you designed for senior citizens. Now, it's so far given us a return of 10.5% every year since we started investing in June 2009. I'm going to go through the funds list on this portfolio. The FT India Dynamic P Ratio Fund of Funds, HDFC MIP, Reliance MIP and UTI Balanced. Dhirendra, for those of our viewers who are looking at this portfolio for the first time, can you tell us what the thought process is behind making such an investment after you have retired?
the thought process was that, we have two goals to achieve here. One is that it should provide a periodic income, but not necessarily a bankable monthly income. The other objective was to, the capital, an investor's capital should not lose its value over time. And that is why it is reasonably equity tilted, but it is managed in a very active way. An investor is investing a lump sum amount into these 3-4 funds, 3 MIPs and 1 dynamic P ratio fund. And what we are doing here is, 2% absolute withdrawal every quarter. And this way, one is able to, the withdrawal rate is not very high. And all the return that we see right now is post-withdrawal. It is taking into account, the return takes into account the amount which you have withdrawn as well as the appreciation.
All right, I'm going to give you a quick recap of the income growth portfolio designed by Dhirendra Kumar. Remember, this portfolio is meant to help you beat inflation after you've retired. Now, I'm going to give you a recap of it. It's the FT India Dynamic P Ratio Fund of Funds, HDFC MIP Long Term, Reliance MIP and UTI Balance. It's time for our product review. Even in our product review, we're going to pick a fund that makes most sense for you after you've retired. Avan is here to give us an introduction into HDFC Prudence, and then Dhirendra will tell us why this is a fund you should be using as retired investors.
Thanks for that, Faye. Launched in 1994, the HDFC Prudence Fund is known to outshine its competition on a regular basis. In the last 10 years, the fund's annual returns have grabbed the coveted top spots at the category at least 6 times. Though it is a balanced fund, the fund manager's aggressive approach has exposed investors to higher risk, but has also rewarded them with higher returns. Even in the market crash of 2008, the fund stuck to its guns and managed to stay afloat and deliver an average performance. And its holding in risky sectors gives the fund diversity and a taste of fundamentally strong companies. Here's the math for you. If you invested 1,000 rupees in the fund when it launched, your money has grown to 2,372 rupees today. So do the returns outweigh the risks? Our experts are here to give you the answer. With that, it's back to you, Faye.
Thanks, Avan. Dhirendra, HDFC Prudence has had a couple of rough patches, but it behaves a lot like an equity fund. Tell us why you think this is the fund that our retired viewers should consider.
Assuming you have invested 15 lakh rupees in senior citizen savings scheme, and so you must invest in a fund like this, because this is the only way for you to protect the value of your capital, because this can appreciate to compensate for the loss in value due to inflation, because you'll be consuming the income from your fixed income investment. And fixed income investment is important because you need it at a defined, predictable periodicity, which any equity combination or any market-related investments can't deliver. Specific period when equities don't do very well, balanced funds are able to do much better simply because they rebalance far more often, and they are able to derive the benefit from the swings of the market. And if an investor attempts to do that on his own, that will be very cumbersome and very tax inefficient. So balanced fund is a great way for people to protect, for retirees to invest to protect the value of their capital. All
right, Dhirendra, finally, your rating of the HDFC Prudence Fund as an option for our retired viewers, where would you rate it?
I would give it a 5-star fund despite, not so great years. When it comes to beating inflation for investors, yeah, it does it best.
All right, 5 stars there for the HDFC Prudence Fund on Investor's Guide. Will help you beat inflation after you have retired. Moving on now, the new investment option became available to us this week. Almost a year after it was announced, the Rajiv Gandhi Equity Savings Scheme in the mutual fund form is finally available as an investment. But not all of us really meet the criteria to invest in this scheme. We've put together a quick list of the conditions you must meet in order to invest in this scheme.
In his final stint as Finance Minister, Pranab Mukherjee announced the Rajiv Gandhi Equity Savings Scheme during his Union Budget speech in 2012. The scheme is designed to give you a tax break of 50% on investments of up to 50,000 rupees in the equity markets. But not all of us make the cut to be eligible for the scheme. You can only invest in this plan if your annual taxable income is 10 lakh rupees or less. Also, this plan is meant only for investors who have never invested in equity before. If you have a demat account, but you haven't used it for any transactions before the 23rd of November 2012, you will still be eligible to invest in the scheme. Now, even if you qualify for the Rajiv Gandhi Equity Savings Scheme, you can't just invest in any stock or mutual fund. Your options are restricted to the stocks and funds that comprise the BSE 100 or the CNX 100 indices. Outside this universe, you're also allowed to invest in public sector companies, which have been awarded a Navratna, Maharatna or Mini Ratna status. Keep in mind though that the scheme comes with a lock-in period of 1 year. Also keep in mind that the tax benefit on the scheme is only for the first year of investment.
With Dhirendra, the Rajiv Gandhi Equity Scheme now available among mutual funds, it is limiting in the sense that these funds can only invest in the top 100 stocks. But for those of our viewers who are not equity investors already, how important is it to take advantage of this option?
First and foremost, you should avoid investing in Rajiv Gandhi Equity Scheme till you exhaust your ATC option, because this is an add-on. Once you have exhausted that 100,000 rupee investment, then you should consider it. Tax save is money earned, so it is worth it, and it is not a bad choice. But it is so limiting that you have to invest once. But I would say that don't consider that option. Think of a mutual fund. You will have 7-8 options to choose from. Maybe by end of this month we will have all fund companies offering some fund or the other, and they are unlikely to be very different because by their design, the investment universe is very well defined.
But Dhirendra, you said yourself that we already have about 7 or 8 options, and it's likely by the end of the month every fund house will give us one option. So as an investor, if I'm trying to choose between these funds, now some of them are index funds, some of them are actively managed, the charges are possibly different on these funds as well. As an investor, how should I pick one fund?
You are broadly going to have two ways to look at it. One is the actively managed and the other is the index options. The Nifty and Sensex trackers will be eligible investment. The case for indexing is still not strong enough even in the large cap universe. Most funds are able to beat the index by a wide margin, and that is the reason why investors should, and you are getting locked in for 3 years anyway. So I would say that go for the actively managed fund. The funds, top 100 or top 50 or even new funds, actively managed fund which will be devised, they will be superior choice, and on a 3-year basis, I'm confident that most funds will beat the index.
So that's the Rajiv Gandhi Equity Scheme. Now remember, if you have a family member who has not invested in equity at all but holds a PAN card, this would be a good option to exercise for them as well. Dhirendra, thank you so much for joining us on the show and answering our questions. Now we have Vishal Kapoor joining us on the show to answer more of the questions you sent in during the week. Vishal, thank you so much for joining us on the show. Our first question comes in from Arun, who retired from the army 2 years ago. Now he tells us he still hasn't cashed out his EPF and his superannuation, which total up to about 34 lakh rupees. Now he uses his pension money for his monthly expenses, and he tells us his income from the pension and the annuity is about 35,000 rupees. His concern, like most of our retired viewers, is the fact that inflation will eat into his savings. He wants to know what he can do to beat inflation. Vishal.
There's a couple of things that we'd like to advise you. Firstly, I think the 4 lakh rupees saving that you need for your child's marriage, that is something that we should set aside and maybe keep it in a bank fixed deposit or a fixed income mutual fund for the period of time that you anticipate that you will need this cash in. Again, based on your comfort level with the types of products that we're talking about, an asset allocation of about 75% in fixed income products and about 25% in equity products to get you going. The 75% fixed income will make sure that you have adequate amount of stability in your portfolio, and it also pays for the short gap that you have between current income of 35,000 and current expense of 40. Now over a few years you will realize that your 35,000 remains fixed, but the 40,000 expense will keep going up. So this gap that you're funding could be increased through dipping into fixed income as the cash flow component coming out of interest or dividends from fixed income mutual funds, etc. The equity component of your portfolio, the 25%, is something we'll start with, but over time bring it down, because that is the objective over there, is to give you growth in the portfolio. So our overall portfolio objective is very simply put, to provide you post-tax returns which beat inflation and cover the current 5,000 rupee expense gap that you have, which is not a lot given the current assets that you have. The third point we would want to make is look at your contingency. So therefore keep some amount of cash. We normally recommend 3 to 6 months worth in an accessible place like a bank account, just in case there's an emergency and you need to dip into that cash. So about 1.5 to 2.5 lakh rupees is what you should keep away in a contingency fund, maybe accessible in a bank account. And the other one is look at your health insurance. You haven't spoken about that, but it's very important that you have adequate health insurance. And if it means dipping into it right now and paying for it, let's do that, sooner than later.
Our next question comes in from Cedric Fernandez, who writes in saying he's 56 years old, retired, he has no health insurance. Now that causes us concern. His investments have been split 55% into debt and the remaining into equity. Now he uses fixed deposits and MIPs for his current monthly needs, and he's also invested in some mutual funds for the long term to beat inflation. Now he has some money left over and he wants to know if he should be investing this in a lump sum in an MIP, or should he use a systematic transfer plan and put the money into equity? Vishal.
Cedric, again, thanks for sharing your details, and I'll quickly get to the first point that I want to make is get health insurance ASAP, so as quickly as possible. Yeah, you're 56, you'll still get a good quote, get it, and plan for the future expense as well. Don't leave it for a later date. The second, now coming back to your portfolio, you could actually look at putting the MIP as a lump sum. It just has a small equity component, so over-diversifying that may be not necessary at this stage. In terms of the STP period, 4 or 5 years is really too long out. So I would think that 1, maximum 2 is good enough. We don't want to lose perspective of the market and have such a small drip coming through into STP that we don't get the benefit of the market's own compounding over that period of time. Looking at the number of schemes, I do think that there is room to consolidate further. Yes, you are achieving diversification by getting into 7 to 9 schemes, but the fact is, do we need as many and do we want to keep life simple? And 3 to 5 carefully chosen funds could get you pretty much that amount of diversification as well. Do look at the corpus size of the schemes that you selected, to also look, apart from performance, to see if, you're not getting into a fund which is very concentrated in any one manner.
Our next question comes in from Venkat Tata, who's also retired. Now he tells us he has some money he'd like to invest in the senior citizen savings scheme, but he wants to know if he should split up that money and invest 15 lakh in his own name and 15 lakh in his wife's name. She's also retired and he tells us she's a homemaker. Vishal, would you recommend they split up the money, that way they can make use of that allowance?
So Mr. Tata, good news for you. Yes, as a senior citizen, your wife, who's a homemaker, can also invest the individual 15 lakh rupees limit. So both of you can invest. So, go ahead and use the opportunity.
All right, that's a wrap on this show. Vishal, thank you so much for joining us and answering our questions. We hope we helped you plan your investments a little better this week. If you have any more questions for us or for our experts, write to us on the email ID that's at the bottom of your screen. Remember, Budget Day is coming up later this month. We'd love to have you in the studio with us on Budget Day, asking our experts your questions. You can get in touch with us, same email ID. Thanks for watching Investors Guide.